Now, let's observe the flag pattern in action on an actual chart. Based on this downward impulse, I decided to enter a trade immediately for 5 minutes with a stake of $1,000. Here we can identify a small ascending channel. Preceding this channel, there was a robust downward impulse leading to a significant drop in price. The flag is a trend continuation pattern that gives you the opportunity to enter the market in the middle of a trend. It occurs when the price of an asset moves up or down in a strong trend that suddenly pauses. Greetings, I'm delighted to have you here for this episode. I'm Mary, and I'll be your dedicated trader today. Are you interested in trading the flag pattern for consistent profits? If so, you've come to the right place. In this session, I'll demonstrate precisely how to trade the flag pattern. So if you're eager to trade like a professional, you're going to find this tutorial extremely valuable. For those who want to engage in trading sessions with me and receive signals, I encourage you to subscribe to my Telegram channel. The link is provided in the description. The price then trades roughly sideways in a fairly narrow range, often moving gently in the opposite direction to the original trend. Two trend lines making the top and bottom of that range now give the pattern of a sloping rectangular shape, rather like a flag. The price eventually breaks out of the flag and continues its original strong trend, giving you the chance to enter the trend at a slightly better price than before the flag was formed. As with most patterns, there is a bullish and bearish version of a flag. The flag pattern occurs when a sharply trending price suddenly pauses and retraces slightly in a rectangular range. It then breaks that range and continues in the original direction, giving you the opportunity to enter the second half of a trend at a better price than before the flag was formed. How to identify bearish or bullish flag patterns. Look at the price chart to see what a bullish flag pattern looks like, and as shown, the price experiences a strong uptrend, but then consolidates into a rectangular range that gently slopes downwards. It then breaks out of that range and the uptrend resumes. On this chart, you can see what a bearish flag pattern looks like. When price movement trades inside a range for long enough, it creates a pattern on the chart that resembles a flag. For the flag to be properly positioned on a chart, an upswing in price activity must have preceded them. A prior upswing is required to form the pole of the bullish flag pattern, which is then followed by a price range to form the flag. The most common bullish flag pattern is a flag range that is slightly declining with lower highs and lower lows. When a downturn is followed by a slightly climbing trading range, it forms an inverted flag and pole pattern, which is known as a bearish flag pattern. In this video, we'll simply talk about the more common bull flag design. A flag and pole is a chart pattern that develops in the context of technical analysis, where there is a sudden move in either direction, the price consolidates in a range following the sharp move, and the price then continues to move in the same direction after it breaks out of the range. Its visual resemblance to a flag and a pole led to its naming. The flag and pole pattern is employed to determine if a prior trend may continue. The price settles in a range after a strong move in either way, and if it breaks out of the range in the same direction as the prior trend, the price gain might be swift, making the trade profitable. Flags are pockets of price consolidation that are closely spaced and indicate a counter-trend move that comes immediately after a significant price directional shift. Typically, the design comprises of anything from 5 to 20 candlesticks. Bullish flag and pole flag patterns have an upward tendency, whereas bearish flag and pole flag patterns have a downward trend. The flag's bottom shouldn't protrude more than the flagpole before it at its halfway. What are different types of flag and pole pattern? An aggressive flag and pole pattern. The price increases during the initial trend move in this illustration of a bullish flag pattern before falling into the consolidation region. When the flag breaks out, we may place the transaction. Your aim should be the length of the flagpole, and your stop loss can be placed in the bottom of the flag. Although a big volume rise may not always accompany the breakthrough, analysts and traders prefer to see one, since it suggests that the new wave of enthusiastic investors and other traders have entered the stock. Polar bear flag and pattern. The price falls during the initial trend move in this illustration of a bearish flag and pole pattern before rising through the consolidation region. When the flag breaks out, we may place the transaction. Your aim should be the length of the flagpole, and your stop loss can be placed at the top of the flag. The volume does not usually decrease during the consolidation phase of a bearish flag pattern. This is due to the fact that investor fear and worry over declining prices frequently underlie negative, downward trend in price movements. The more precise the decline, the more pressure there is on surviving investors to act. By only defining 3 crucial points, entry, stop loss, and profit target, a trader may create a method for trading such patterns using the dynamic of the flag pattern. Entry. It is advisable to wait for the initial breakout to avoid getting a misleading signal, even though flag tends to point to a continuation of the present trend. The day after the price has broken through and closed above the upper parallel trend line is often where traders anticipate entering a flag for long positions. The day after the price has closed below short position, the lower parallel trend line in a bearish pattern. Stop loss. Traders often anticipate using the flag pattern's opposing sides as a stop loss position. A price level below Rs51 per share would be a suitable spot to set the stop loss order for a long position. For instance, if the upper trend line of the pattern is at Rs55 per share and the lower trend line of the pattern is at Rs51 per share. Profit objective. Conservative traders could choose to utilize the price differential between the parallel trend lines of the flag pattern to create a profit objective. The trader would set a profit objective of Rs59 if there is a differential of Rs4 and the breakout entry point is Rs55. Setting a profit objective by measuring the distance between the pattern's top and the flagpole base would be a more ambitious strategy. Now, let's observe the flag pattern in action on an actual chart. While theory is informative, it's more beneficial to witness its application in practice. At this moment, on the USD and Japanese yen currency pair, there is a prominent downward impulse. Based on this downward impulse, I decided to enter a trade immediately for 5 minutes with a stake of $1,000. I took the opportunity to open the trade promptly to avoid missing out. Here we can identify a small ascending channel. Preceding this channel, there was a robust downward impulse leading to a significant drop in price. Subsequently, a correction occurred leading to the formation of the chart pattern obsidian, an inverted bearish flag. Now let's apply simple logic. Price is presently breaking the correction in a downward direction. This means we have an initial downward impulse followed by a correction breaking downwards. Our next step is to wait for a movement equivalent to our initial impulse. Interestingly, an ideal situation has developed on the chart, as the distance from the initial impulse to the correction is approximately the same as from the correction to the support zone. I entered the trade right after the flag breakout. It is vital to enter such trades only after the flag breakout has already commenced. If the flag breakout has not yet begun, and the price is trading within the channel, it's better to refrain from entering the trade. In some cases, waiting for a minimum uptrade might be beneficial. Watching the current price level, sometimes it's wise to wait until the price drops to the lower point from which the correction began. This minimum update serves as the maximum confirmation that the flag pattern is unfolding. Flags has proven to be effective over the past 6 months, and they belong to the ancient chart patterns that played a crucial role in the inception of technical analysis. They have remained relevant due to their consistent efficacy. Overall, this trade is simple and pleasing. I decided to open it for 5 minutes instead of the usual 3 to provide some extra time to prevent potential losses due to randomness in case of correction. Now let's patiently wait for its closure. I decided to extend the trade duration, and it's paying off. The trade is about to close with a profit and the flag pattern executed flawlessly. Thank you for your attention, and I look forward to your subscriptions to the channel. Do not miss the new episodes. I hope you'll find it interesting to follow along because it's interesting, right? Text me in the comments.